Morning. I want to thank everybody for joining us today. Today, I want to talk about charitable remainder trusts and really how this can be win-win planning for both your clients, for the charities that you're involved with, really how it can be a big planning opportunity and solve a lot of problems for clients that want to move on from their real estate, time to change their investments. So let's take a look at how this can help. If you look at the goals for charitable remainder trust, this is for clients that are charitably inclined or clients that want to get rid of a huge tax burden. They have highly appreciated property that is being sold. And if you think about, clients that are just tired of fixing toilets, tired of taking care of that rental property that they've been taking income from for years, and just it's time to move on, but they want to protect their legacy to their heirs. So think about those types of clients and what this can do for them. If you're an advisor, this is a great way to help your clients both achieve their charitable goals and their tax savings goals. And it's a great way for you to expand your business by being able to help people with their charitable planning. As we look at this is a realistic case, and this is comes from a case that I worked on a number of years ago. But husband and wife, both age 75, they were charitably inclined. They had an apartment complex that they had held on for years. They were tired of the maintenance, but just didn't know how to sell it without a huge tax consequence. So their goals was to reduce their income tax and provide a legacy to their descendants. If they were to sell this property, and the property was valued at approximately $1 million, that their current basis in the property because of depreciation taken was $100,000. So they were going to have a gain of $900,000. But that's not just the whole picture. That $900,000 was going to be depreciation recapture. It was going to be part capital gains and part return of basis. So, out of that $900,000 of gain, $250,000 of that would be depreciation recapture. So you start looking at this and can understand why, somebody may not want to sell this property. But if we can help them position this in a better tax framework, we're going to help them be able to move forward. So if you look at a charitable remainder trust, with a charitable remainder trust, our clients get to design the trust. They get to decide what terms they want in the trust, and they can be their own trustee, but they're going to put the trust in place. Once the trust is in place, signed, ready to go, they have to transfer in this case, the apartment complex to the charitable trust. That has to happen before any sales agreements are signed. Once it's in the trust, now they can sell that property income tax free and reinvest those proceeds inside the trust. So take a step back and think about that. If they're going to sell this property outside of the charitable trust, well, they sell it for $1 million. They've got capital gains tax to pay, ordinary income tax to pay. They've got the net after tax to reinvest and use for the retirement. With this being sold inside the charitable remainder trust, now they can reinvest those proceeds inside the trust. So now we've taken $1 million of apartment and exchanged that for $1 million liquid portfolio designed however our clients want it to be. And then again, they can be the trustee and help decide how that should be invested. When we set up the trust, we're going to name one or more charities. These charity designations can be revocable or irrevocable. And what I find from a lot of clients, they want to keep that revocable so that they can change that, over time as their charitable goals change. If they have a long-term relationship with their church, with their community, maybe they want to make it irrevocable, but I find most do keep it revocable just in case they want to change their mind down the road. Once we have this set up, so once the trust is set up, when we transfer the property in, that's going to trigger our charitable deduction. Well, with our charitable deduction, it's going to be based off the amount of annuity payment that we're going to pay back to our clients on at least an annual basis. And we can set that payment up monthly, quarterly, semi-annual, or annual. But at least annual, that will pay out a percentage back to our clients every year. Now, that percentage can be either a percentage of the $1 million, and that's called a charitable remainder annuity trust. It'll be the same payment every single year. So if it's $1 million at a 5% payout, it would pay out $50,000 a year every single year. Or we can have a charitable remainder unit trust, which is 5%, if that's our percentage number, of the January 1st value every year. So if the investments can grow, well, the first payment might be a 5% of $1 million, maybe next year's 5% of 1.1 million. But if our investments are growing better than 5%, we're going to have an increasing payout every year. So there again, it's what the clients want to do. And at some point in time, either if this is for our joint lifetimes for our clients, at the end of the second death, then whatever's left in the trust will distribute out to the charity. If we have that set up for, say, a 15-year trust or a 20-year trust, at the end of the trust term, that's when it goes to charity. So our charitable deduction is based off the amount of money the value of that property we transfer to the trust, the amount of annuity payment that we take back each year, and what the expected life expectancy is of our clients, or the number of years. So when, that will transfer out to charity. So that's an IRS calculation that we always go through with our clients to make sure this fits for them. But this creates an income stream back to our clients. It creates a big, payout potentially to the charity at the end of the trust. All of these things work. We just need to make sure that we follow the rules. No debt can be on the property, and we want to transfer that property into the trust before any sales agreements are signed. So let's look at this. If in this case, our clients, joint lives, they're both 75. So, at that age, paying 7%, so a $70,000 payment, we would create a charitable deduction in year one of $382,080. They can use up to 6 tax returns to use up that charitable deduction, because there are limitations in how much they can take each year on their tax return. But that allows us to, have a big tax return. We're going to have at least $70,000 a year paying back to our client, so that they can use that for their expenses, living, whatever. And if you think about that payout, it's going to, they can either use that money, that premium, for premium for life insurance, they can keep and spend it, or they can give it to their heirs, charity, whatever they want. But that just is part of their income that they can use every year to use for their life expectancy. Now, if you look at the first, number one up there, it's life insurance to create a legacy for their heirs. If you think about this, we've now taken $1 million out of their assets. We put it into trust, and that'll eventually go to charity. If we want to, we can create a legacy replacement so that we get a life insurance policy that will replace that $1 million back to the estate or more. The advantage is we've benefited the charity. We're using life insurance that will pay out income tax-free to the heirs. And if we want to, we can protect that in a trust so that it's all protected. So creditors can't touch it, estate tax can't touch it, income tax can't touch it. Our heirs are benefited, the charity's benefited. It really creates that win-win scenario, and can help a lot of our clients as they're selling these appreciated properties to be able to move on from the properties, move on from those investments, create an income for them, and still benefit their family the way they want to. So it's a great planning strategy. It's a great way to help our clients, and they're, again, great way to help charities to get the money they need to do the good that they can do. So I appreciate everybody getting on. If you have any questions, feel free to reach out, and we'll talk again next week. Thank you.